You hear this question every year, Roth or traditional. It sounds like a personality test. It is not. By the end of this video, you will be able to pick the option that fits your tax rate today, your likely tax rate later, and your cash flow. You will also know exactly what to check on your pay stub and last tax return to make the call without guessing. Let's use one realistic example the whole way through. Meet Jordan. Jordan makes about $85,000 a year, contributes to a workplace retirement plan, and can set aside $500 a month for retirement. Jordan is deciding where that $500 should go this year. Here is the mechanism in plain English. A traditional contribution usually lowers your taxable income today. That can reduce what you owe the Internal Revenue Service this year. But when you pull the money out in retirement, those withdrawals are generally taxed as income. A Roth contribution is the opposite. You pay the income tax now on the money you contribute. In exchange, qualified withdrawals later are generally tax-free. So, the trade is simple. Do you want the tax break now or the tax break later? Most people stop there. That is where the wrong picks happen. Because the real question is not which is better. The real question is, what is your marginal tax rate today? And what will it be when you take the money out? Marginal tax rate just means the tax rate on your next dollar of income, not your average, the next dollar. That one detail changes everything. If you are in a relatively low bracket today, paying taxes now can be the cheaper deal. If you are in a higher bracket today, taking the deduction now can be the cheaper deal. But we still are not done, because cash flow matters, and so does flexibility. Let's translate this into Jordan's month. Jordan has $500 a month to invest. If Jordan chooses Roth, the full $500 goes in, but Jordan has to cover the taxes out of their take-home pay. If Jordan chooses traditional, the $500 still goes in, but the paycheck withholding can be lower because taxable income is lower. That means Jordan might feel a slightly easier month. Sometimes that is the whole reason traditional is the right choice in a given year. Here is a quick numbers pass so you can feel it. Say Jordan's marginal tax rate is about 22%. If Jordan contributes $6,000 over the year, a traditional contribution could reduce taxable income by that amount. The rough tax savings on the margin could be around $1,300 for the year. That is about $110 a month. Not exact, because tax returns are messy, but close enough to make decisions. So the question becomes, is it easier for Jordan to do Roth and still handle the month? Or does Jordan need that extra $110 of breathing room? Now we build the decision table. You can make this call with 3 signals, and each one has a place you can actually look. Signal 1 is your tax bracket today. Here is where to look. Pull up last year's tax return. Find your taxable income and look at the bracket that you landed in. Then look at your pay stub this year and your year-to-date taxable wages. You are checking whether you are roughly in the same zone or whether your income jumped. If you are in a low bracket now, Roth becomes more attractive. If you are in a higher bracket now, traditional becomes more attractive. That is not a rule. It is a starting point. Back to Jordan. Jordan is in the low 20s bracket most years. That means Roth is at least on the table. Jordan is not paying 32 or 37% taxes. Jordan is not in a take every deduction emergency zone. Signal 2 is your expected bracket later. This is the part people overcomplicate, so keep it simple. Ask 2 questions. First, do you expect your income to be meaningfully higher later in your career? Second, do you expect to have taxable income in retirement from multiple sources, like a pension, rental income, a large taxable brokerage account, or a spouse with high income? If you think your future tax rate will be higher than today, Roth becomes more attractive. If you think your future tax rate will be lower, traditional becomes more attractive. Jordan expects raises. Jordan might be in a higher bracket in 10 years. That leans Roth. But there is a counterweight. Signal 3 is your cash flow stability. This is not about being disciplined. It is about whether your budget can handle paying the taxes now. Here is where to look. Check your last 3 months of checking account statements or your budgeting app. Find your average surplus, meaning what was left after bills and normal spending. If that surplus is thin, traditional can keep you consistent. If that surplus is healthy, Roth is easier to sustain. For Jordan, the month is tight. Not desperate, but tight. That means doing full Roth might require cutting back somewhere else. And if that causes Jordan to stop contributing in 6 months, that is worse than picking a slightly less optimal tax bucket. This is the first big takeaway. The best choice is the one you can keep doing. Now let's zoom in on a common misread. A lot of people think Roth always wins because tax-free sounds unbeatable. But tax-free later only beats a deduction now if your tax rate later is the same or higher. If your tax rate later is lower, traditional can win on after-tax dollars. Here is a simple illustration. Imagine Jordan pays about 22% tax today. If Jordan chooses Roth, Jordan pays that tax now and locks in tax-free withdrawals later. But if Jordan retires in a lower bracket, maybe closer to 12% on a chunk of withdrawals, traditional would have been cheaper. Jordan would have gotten the deduction at 22% and paid taxes at 12% later on those dollars. That difference is real. It is also why the best answer for a lot of people is not all Roth or all traditional. It is a blend over time, not because diversification sounds smart, because your life does not stay in one tax bracket forever. Next, let's build a clean 2-path plan for Jordan that fits both the tax math and the monthly reality. Let's keep it simple for Jordan. Path 1 is Roth heavy this year. That means Jordan keeps the full $500 a month going into the Roth bucket and covers the taxes out of take-home pay. The upside is you lock in today's tax rate on those dollars. If Jordan's income rises later, this can look smart in hindsight. The downside is obvious. The month gets tighter. If that pressure causes Jordan to miss contributions, the better tax bucket doesn't matter. So the practical rule is about stability. If paying taxes now forces you to pause investing, the Roth advantage disappears fast. Path 2 is traditional heavy this year. That means Jordan gets the deduction now, which can reduce current year tax on the margin. In real life, it often shows up as slightly more breathing room in the paycheck. The upside is consistency. If Jordan can keep contributing every month because the budget is less stressed, that is a real win. The downside is you're choosing to pay tax later, and tax later depends on what your retirement income looks like and what tax rules look like decades from now. So here's the clean decision rule. If your budget is fragile, stability comes first. Traditional can be a better fit in a year where cash flow is tight. If your budget is stable and you expect higher income later, Roth becomes easier to justify. Now, a quick counterpoint. Some people say, what if taxes go up in the future? That's possible. Another reason this might not show up the way you expect is that your tax rate in retirement can be lower, even if tax rates rise overall, because you control how much you withdraw each year. So the practical way to frame it is not taxes will be higher. It's what will my personal taxable income be when I take the money out? That's why a blended approach is so common and so rational. A lot of people end up building both buckets over time. Some years they lean Roth, some years they lean traditional. And the reason is simple. Your income moves, your family situation moves, and your ability to handle taxes now versus later changes with it. Let's bring Jordan back in. Jordan expects income to rise, but the month is tight. So Jordan might decide to split contributions. For example, Jordan might put $300 a month into Roth and $200 a month into traditional. That keeps some tax-free future flexibility, while still capturing some deduction now to steady the month. That is not a magic ratio. It's just a way to match the plan to reality. Now let's talk about the most important what to check items, because this is where people guess instead of verify. First, check your pay stub. Look for your year-to-date taxable wages. Then look for your year-to-date retirement contributions, if your pay stub shows them. If you increase a traditional contribution, your taxable wages for the year should generally be lower than they would have been. That's one way to sanity check that you're actually getting the deduction you think you're getting. Second, check your last tax return. Find your taxable income. Then note the bracket you were in. You do not need to predict your exact taxes. You just need to know whether you are in a low, middle, or higher zone today. Third, check your real monthly surplus. If the surplus is slim, don't build a plan that depends on perfect months. Build a plan that survives normal life. Now, a common mistake. People treat this choice like it's permanent. It's not. You can change direction next year. The bigger risk is picking a choice that feels mathematically perfect and then abandoning it in 6 months. So, let's convert this into a simple table you can hold in your head. If you're in a low bracket today and you expect higher income later, Roth gets stronger. If you're in a higher bracket today and you expect lower taxable income later, traditional gets stronger. If you're not sure about the future, you can treat flexibility and consistency as the tiebreaker. And that brings us back to those three signals. Keep them tight. Your bracket today, your likely bracket later, your cash flow stability. If two of the three point the same direction, that's usually your answer. If they split, blending is a reasonable way to reduce regret. Now, there is one more layer that matters for intermediate people. Your retirement plan at work may offer both options, but the match details can vary. A common approach some people consider is this. They direct their own contributions toward the bucket they want, but they treat the match as a separate piece of the puzzle. The main thing to watch is that you understand where each dollar is landing and what that means for taxes later. You don't need a perfect strategy. You need a strategy you can run for years. Now, here's a quick 2-minute checklist you can run to close the loop. Start with last year's tax return and find your taxable income. Write down the bracket zone you were in. Then grab your most recent pay stub and check your year-to-date taxable wages. If your income is meaningfully higher this year, your bracket today might be different. Next, check your monthly surplus over the last 3 months. If your budget is tight, lean toward the option that helps you stay consistent. Then pick a simple plan for this year. Roth, heavy, traditional heavy, or a split that keeps your month stable. Finally, set one reminder for mid-year. You're checking whether income or cash flow changed enough to adjust. Before we wrap, let's run Jordan through the table one last time, because this is how you avoid regret. Jordan is in a middle bracket today and expects income to rise over the next decade. That points toward Roth as a strong long-term play. But Jordan's month is tight. That points toward traditional, or at least not going all in on Roth, because the real risk is stopping contributions when the budget gets squeezed. So, Jordan picks a split for this year. Enough Roth to lock in today's rate on some dollars, and enough traditional to keep the month stable. Next year, if income rises and the budget relaxes, Jordan can shift more to Roth. If income drops or expenses spike, Jordan can lean more traditional again. The point is to keep the plan alive. Now, 2 quick reality checks that save people from mistakes. First, if you are tempted to choose Roth because you want tax-free later, ask yourself one question. Will you likely be in a higher tax rate later than you are today? If you do not have a clear reason to believe that, treat Roth as a preference, not a certainty. Second, if you are tempted to choose traditional because you want the deduction, ask yourself one question. Will you still be happy paying tax later if you end up with multiple income streams in retirement? If you think future taxable income could be high, a Roth component can protect flexibility. And here is the cleanest way to frame it without overthinking. Traditional is buying you room today. Roth is buying you room later. Neither is automatically smarter. The smart move is matching the tax timing to your real life. One more practical check. Log into your retirement plan portal and confirm the contribution type is set the way you think. Some plans let you choose Roth, pre-tax, or both, and your paycheck can look similar either way. Verify the bucket, then verify the percentage, then verify the next pay date shows the same setting. These are general education rules, not individual advice. Last quick checklist, condensed to the fastest version. 1. Check last year's taxable income and bracket zone. 2. Check this year's pay stub, year-to-date taxable wages, so you know where you are trending. 3. Check your monthly surplus, so your choice does not break consistency. 4. Choose a direction, Roth heavy, traditional heavy, or a split, and set it on autopilot. 5. Set one mid-year review point, because changes in income and cash flow are what actually change the answer. If you want the simplest decision rule to remember, it is this. If you are in a low bracket today and expect higher income later, lean Roth. If you are in a high bracket today and expect lower taxable income later, lean traditional. If you are unsure, blend and prioritize consistency. That's the whole game. A tax decision you can stick with beats a perfect plan you quit. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.